market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, while the global landscape in 2026 is defined by shifting trade alliances, geopolitical friction, markets maintain a resilient, if cautious, momentum as businesses navigate the transformative challenges of AI. And despite the uncertainty, Italy's UniCredit has signaled its own strength by pledging a landmark €50 billion return to investors through 2030. Well, Andrea Orcel, the chief executive of UniCredit, is here. Andrea, as always, thank you so much for giving us a little bit of your very busy schedule. So give me a sense of, yesterday was a big day for you, for a lot of investors, higher profits, stronger capital distribution, higher investors' returns, somewhat what you announced. What are the levers you're going to pull to try and achieve this?
So good morning, Francine. I think we start from a 2025 that was better, much better than we expected, especially at the operating level. And that allowed us to close the year beating estimates, but also taking a 1.4 billion charge to propel the future and protect the future performance. So we enter 26 with much greater momentum than we entered 25, and we can protect it to a greater extent. So we start from that. On this, we overlay two things as we move our strategy from unlocked to unlimited. And the two levers are a further acceleration of our top line by having an ambition to gain market share in the targeted segments in every single market where we are. And secondly, let's call it a transformation 2.0 by further enhancing our operational efficiency. I think the objective for us is, as we get 2030 ready, we think that the competitive landscape is going to change dramatically. You will not have legacy banks on one side, fintech on another side, hyperscalers on another side, but one combined competitive environment. Right. And we need to step up to be able to not only be challenged, but challenge them in return. Fewer banks or more banks by 2030? I'm pretty convinced that it will be fewer banks. Fewer banks because of consolidation, or just because they'll be wiped out by I think it's both. I think it's both. When we look now at the transformation that is occurring through AI, but not only through AI, I think there will be winners and losers, and the dispersion between winners and losers will be much, much greater. Some will consolidate, some will be wiped out. Andrea, I know cost discipline remains central to what you're trying to achieve, so where do you still see efficiencies? Well, I think when we move to the transformation 2.0, it is a continuation on what we had. Before we had an ambition to keep our costs flat during the foreseeable future. Now we move to minus 1% per year. But it is a little bit misleading because in this minus 1%, we're also stepping up investment in technology and AI to transform ourselves to where we want to get. So where do we see efficiency? The entire way of working of banks is changing. So if I was a fintech today, I would not be organized the way a legacy bank is organized across any of the major organizational construct, processes, way of working. So one by one, we're taking them down and we're redrawing them. But now what has allowed us to leap forward is the fact that we are applying AI and modern technology in the way we look at what we can do, and obviously the impact is much greater than it was before. Andrea, it was very clear in the last week or so that actually AI took a big chunk of the markets out, but this was not really on concern about valuation. It was on concern about the business model, that it could disrupt, for example, software companies, but also touching asset managers. How quickly could that disruption come? I think the disruption, and I think we need to distinguish on who is producing AI and who is using AI. If I saw statistics that only 3% of AI is getting paid for. So for who is producing AI, the big challenge is domination of that market and getting ahead. So a lot of investment for that outcome, and it is for investors to determine if this is worth it or not. For users, it is a question of adoption, and it is much more difficult than people estimate, because number one, to adopt, you need to be willing to change. Yeah. If you're willing to change, you need to be willing to have the social impact that change will require in certain part of the bank for us. And therefore, you need to be ready to upskill and recycle and move your people from one function to another and accompany that move in a correct way. Otherwise, it just cannot be done. And so how fast can you do that is the question. Our plan talks about circa when we talk about net profit, because We think there is a range, depending on how fast and decisively we can move vis-à-vis a center point, and most of it is determined by how much bottom-up the team is ready to embrace that change, and how we are able to protect our people and use a lot of this upskilling to change careers and move in new function our people.
But it's still very ambitious targets. So what are the main risks actually to having these sustained targets?
Well, I think let's call it on the top line, the main risk is that some competitors who cannot achieve growth in inverted commas the right way, slash margins, slash pricing, and therefore affect the market. We think that this is not very likely in Europe, given where we are and given the capital position of everybody, but it is always possible. We hedge that by growing not in an undifferentiated way, but growing very targeted on small and mid caps, on micro businesses, on affluent, on private. And in those segments, the competition is a lot more fractured, but it is possible. On the bottom line or on the operating line, the issue is there aren't much risks. It is mostly linked to the speed and the effectiveness with which we roll out AI. Right. And it's not about rolling out AI, this requires a fundamental change in how we operate. Right. Can we have enough people across the organization who are ready to say, I was doing things this way, I'm going to do them that way, and I'm going to execute, because it's no longer a top-down imposition. So these are the two things. Obviously, in that you have cost of risk that may change. At the moment, we stay at 15 basis points, which is the level we've had for the last couple of years. We don't see any stress. We have 1.7 billion of overlays, more than anybody else, to protect that. And we think in the next 3 years we can keep it at 15 to 20. So we are relatively comfortable of that. The general macro is an issue, or the general geopolitical environment is an issue. But
not for the market.
Not for the market. And I would say we get hit indirectly only. We have chosen to be a pan-European bank focused on Europe. 98% of our bank is on Europe only. Yeah. And therefore, a lot of things that occur outside, we get the reverberation into Europe. And if you look at European Union, the first round of trade barriers has gone relatively well.
Andrea, 2030, will you stay on for CEO for that long?
It's for shareholders to decide, but I'm excited. I'm very excited. And I think for me and the team, we started an adventure together. We've unlocked. We achieved much more than we thought we could do. And now we're starting on another adventure. Everybody at UniCredit is quite excited, motivated, galvanized by the new achievements, and I would like to leave them.
But if you're wanted, you don't have any other plans?
I don't.
Talk to me a little bit about what we've seen in the market so far. So it's AI. We also saw the appointment of Kevin Walsh. Are you expecting just a lot more volatility? I think,
and we discussed this, Francine, other times, we come from a long period of relative stability, but the new normal is not that. We are going to have quite a long period of volatility. Is it through geopolitics, trade barriers, changing in the way we see things that we weren't accustomed to see before? I think the appointment at the Fed is viewed positively by everybody. I think there are a lot of positive things in this world that are occurring, but there is also a lot of redefinition of things that my generation gave for granted and are no longer. So I think for any institution, and for us in particular, we went from managing budgets to manage a direction around which empowered people adjust almost daily as they watch your show, because things change almost daily and you need to reset almost daily.
Yeah, and the speed at which it's changing is quite breathtaking. Talk to me about Commerzbank. So you still have a sizable chunk in Commerzbank. What will you do with it?
Look, I think I would start with this. With the new UniCredit Unlimited plan, we are in the enviable position of being able to cross two models of banks in Europe. There are the banks who return a disproportionate amount to shareholders. There are the banks who tend to grow more than average. Yeah. By executing this plan, we will be at the top on both items. We will not have to compromise growth to deliver best-in-class return to our shareholders. And on top of that, we have excess capital to be able to accelerate that organic growth or inorganic growth. So the starting point is that's the focus. Having said that, I believe in stronger, larger banks, especially in Europe. I don't think Europe can transform without bigger, stronger, larger banks. We have more optionality than everybody because we're in 13 markets. Our competitors tend to be in 1 or 2, so we get more noise than others. With respect to the stakes we have, and in particular Commerzbank, I think we made the investment on certain premises. We're in a different situation. We're not going to go back through the story. We are happy with the contribution that it gives us. You see in our plan, those 2 stakes will support and offset all the compression for Russia. For us, if the shareholders of Commerzbank decide that they want to join what we are capable of generating and recognize that our blueprint generates value, we're fine. But what we will not do is compromise the returns and the business case for UniCredit core launching into an acquisition that is dilutive to the shareholders of UniCredit. So if that is the case, we will continue not to move.
I mean, I think there's a lockup period for a potential paper deal expiring at the end of February. Could something happen in terms of offer then, or are we just in a wait?
Let's say that something can always happen, but you know very well that the situation is relatively complex and relates to a number of constituencies who have very strong views on that. So it's not only about paper deal, not paper deals. And I think it's important to look at, or at least how I look at, for me, M&A, AI, technology, Commerzbank, these are means to an end. The end is, can we build the best bank UniCredit can be and deliver in the process for shareholders and a model that sustainably grows above market? That's the objective. If we can do, if Commerzbank or anything else contributes to that and can be done in a way that contributes to that, we are open to consider. Otherwise, we're not.
Do you feel more pressure potentially to buy something in Italy because of the M&A consolidation that we're seeing in the country?
Well, like me, you're half Italian, so you know very well what happens there. I think at the moment the environment is relatively stable, if you want to call it that way. There are core shareholders controlling most of those situations. So the topic is for those core shareholders to determine. For as long as those core shareholders are very happy with the situation they have, I think very little will move.
So you don't feel the need to get involved?
Well, look at the results of Italy this year. We have 27.5% return on equity. We are growing. We hired 1,000 people on the front line just in the last 9 months of 2025. We're going to hire another 1,000, and we're stepping up growth above the sector. So no, we don't feel the pressure.
What about anything in the U.S.? We're hearing, even Santander did a big operation there.
No, I think we, at least for now and for the foreseeable future, we believe very strongly that we need to remain where we make a difference. We make a difference in Europe. We make a difference in the CE. That's where we remain. We are betting on Europe, and we think that this is a very good bet for us.
I know yesterday there was a lot of, it was one of the most read stories on the Bloomberg terminal, the fact that you have $50 billion, right, to give back over the next 5 years. If you do a large M&A deal, would that change that policy in any way?
It is $50 billion, and as I said, it is $50 billion without compromises growth. So the big change is that the $50 billion are ordinary distribution. So it's 80% of net profit, and we think we're going to deliver those. Actually, we're convinced, while growing. M&A, again, at the end of the day, there are always 2 things in distributions. There is dividend. Those tend to be considered sacrosanct on banks. Then there is share buyback, and at least intellectually, buying back your own shares at a certain return or buying back the shares of something else that adds more value to you and becomes part of you is not very different. So for the time being, those returns are quite safe. We don't see anything on the horizon.
Andrea Orcel, thank you so much for joining us. That was, of course, Chief Executive of UniCredit. Now, Barclays is also planning to return at least £15 billion to investors by 2028 after fourth quarter earnings beat estimates. Its fixed income and equity traders had their best fourth quarter since at least 2016. Flat income at its investment banking unit actually narrowly missed. Barclays now targeting a return on tangible equity of 14% by 2028, planning efficiency savings of about £2 billion to help it get there.
I'm very pleased with the numbers. Our top line is 29.1 billion, which is 9% higher than it was a year ago. Our bottom line, 9.1 billion pounds profit, which is again 13% higher than it was a year ago. And all parts of the bank, including the investment bank, firing on all cylinders, ROTE of 11.3%, and capital distribution of 3.7 billion pounds compared to 3 billion a year ago. The new strategy is about acceleration of what we've been doing.
That was Venkat, the Barclays CEO, speaking to us this morning. Coming up, how will a raft of key U.S. economic data play out in the markets? We'll delve into that conversation with UBS Investment Bank's Global Head of Economics and Strategy Research, Arend Kapteyn. That's next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. So it's a blockbuster week for U.S. data as we get three reports that would normally be spread across 2 or 3 weeks. Retail sales, jobs, and CPI data likely to create more volatility with the markets. Now, with us now, Arend Kapteyn, Global Head of Economics and Strategy Research at UBS Investment Bank. Arend, thank you so much for being here. I want to go on to your conviction list, but I keep on, you have one of the best notes, frankly, that I like reading because they're simple, they're to the point, and they're targeted. And you always start with what investors ask you. I mean, over the last quarter, has it changed, or is it much of the same, but actually the stress points are different?
So it is constantly changing. I mean, if you think 6 months ago, I don't think we appreciated, for instance, on the U.S., how incredibly narrow growth was. It was one giant bet on AI. That's now, I think, very clear. Yep. But now, of course, it then becomes about, okay, but, how long can that last? And you start to see the rotation away from the CapEx cycle, which feels like it's going to start to run out of steam at some stage. So what is the next big thing? So there's a lot of that. I think the other thing that clients have really struggled with is just explaining the price action of certain assets. So the traditional models and things like gold completely broke down last year, but then you can basically run new models, and what you find is that everything was basically due to policy shifts in the U.S., and you can do return attributions and things like that. So there's sort of constantly, I think under this U.S. administration, I think a lot of the correlations breaking down, et cetera, has just confused people. And so now it's really, trying to make a prediction whether this year is like last year, where you get more of the same, or whether it's going to start behave more normally again. Yeah,
and you're right. Correlations, kind of come and go, right? We saw the dollar correlating last week. We saw Japan kind of going back to some of the things that we were used to. What are your core convictions in these kind of wonky markets?
So I think very big picture, I think, globally, it looks everything is getting better. Okay, so central banks have cut rates in half globally. You're starting to see credit respond. You're seeing growth broaden out sort of outside the U.S., right? So confidence is going up. Hard data is accelerating. We're back at trend-like numbers. You're not really seeing much of an impact of the tariffs, right? So the big picture is everything actually looks pretty decent. I think, it's interesting how quickly the narratives sort of shift. I think like a month ago or 3 weeks ago, before Warsh had been appointed, there was sort of this conventional wisdom. He was hawkish, and that would then strengthen the dollar. Now there's a rethink that, well, actually, maybe if you take at face value what he says, he would be, within the 19-person sort of, board of governors system, he would probably be like the second most dovish, right? So now there's a rethink about, well, maybe we get more dollar weakness. So I think, I think really a lot of the outlook is going to be about what the U.S. does next policy-wise, right? So first of all, do we see the tax refunds reaccelerating the economy? I think it's too soon to tell. Do we see a potential attempt to do a reconciliation bill going into the midterms because the administration panics about what the poll numbers are saying? Those are going to be the things I think really driving the markets. And
Arend, I mean, is there also a quality actually growth in the U.S.? Because I know the numbers are fine, but if you look at the K-shaped recovery, I mean, there's also this inequality with affordability, and I don't know whether it props up into the markets or again the policies that the White House will put in place.
So Q3 looked a bit better than Q1, Q2, but it does not look good at all, right? In the sense of, I mean, if you go back, 2 years ago, what we would sort of say AI capex and the top 20% consumption was driving about 35% of growth. It's now driving about 85% of growth. Right? That's not a healthy dynamic. But then what's intriguing that even within the wealthy, if you look at, say, the Michigan survey, the top third of the income distribution is the most worried they've ever been in the history of the series about their employment prospects, right? And so there's sort of an AI element sort of running through it as well. The labor market is largely stagnant despite having really high headline sort of growth rates. So these are all things that feel to me, feel like a fragile equilibrium, right? This is not something that is necessarily sustainable. But I think, prospectively, if you look at what's supposed to happen in the next couple of months, we are at the margin seeing some glimmers of, I think, that broadening out. I think the labor market looks a little bit better. We'll find out, obviously, tomorrow whether it starts to get better. And so I think the narrative of the U.S. growth broadening out a little bit and including other parts of the population, I think, is probably valid. But the survey data really worries me. The surveys have not actually improved since August, if you take them collectively in the U.S. And in my mind, you really need to see confidence go up before the spending can broaden out, and that's not happening yet.
What's happening in China? Are we really importing deflation from China?
Sort of a massive scale in the sense that their export prices are falling so much faster than their main competitors. Right? So Europe is sort of most extreme, where over the last 3.5 years, China has lowered its export prices by 33 percentage points more relative to Europe than they've done, and so effectively that's a stealth depreciation. And so they are they're gaining market share everywhere. It's partly a function of them being competitive everywhere. I think all the new technologies they sort of dominate. You see that now increasingly, I think, in the activity data as well, but certainly I think what's happening on the sort of export deflator front is giving them, I don't know if it's an unfair tailwind, but it's giving a big tailwind in terms of capturing more market share. But I think the positive spin on that is that, for all the worries about China's growth the last couple of years and the property market now being in 6th year of decline and people worrying about tariffs, compositionally I think growth is getting better. It's broadening out to all these new technology sectors, and that's actually now contributing more than the old sectors like property a couple of years ago. So it looks like the number's not changing, but I think actually people are feeling better and better about China. It's an AI play, and so it's not.
Your take on Japan? A big week for Japan, but a lot of questions actually what the Prime Minister will do fiscally. Yeah. So the amazing thing is how much the market has already responded to the relatively small amount of fiscal slippage that we've seen in the last couple of months, right? So by our count, it's maybe a percentage point of GDP in fiscal slippage. So they're running a 2% primary, negative 2% primary, but they have huge buffers. So the interesting factoid about Japan is that despite having 230% of GDP in debt, they're basically one of the most sustainable countries in the world because the carrying cost of debt is basically zero. Now, why is it zero? It's because they have about 100% of GDP in assets on which they earn about 6% of GDP per year in revenues. So if you take the net cost of all their debt and you include the assets, then they just have very large buffers. Now, for the market, that's hard because, of course, you can't look at that statically. If you have a government that gets a new mandate, comes in and says, well, we're going to do another percentage point of GDP in stimulus, then of course, you start to worry about the direction. And so I think the market is sort of right to wait here, see what the government does with the mandate. My guess is the focus near term is more on some of the national security things than the fiscal stimulus, so that could be a 27 story. But the market feels like it's moved a lot here relative to, I think, the solvency. Can you say that about most markets, that they just preempt to a point? I don't know if it's because they don't want to get anything wrong, apart from geopolitics, that they don't know how to price.
It's been a turbulent sort of January. So it's
you don't say.
So Japan, I think, has moved a lot in JGBs, right? I think the other markets haven't really moved that much. The dollar has moved more than we thought coming into the year, but that's, I think, because of Greenland and some extending of the rotation trade. I think actually what's remarkable is where we are now year to date. I mean, you look at the index levels, we haven't moved that much, but it's been sort of pretty volatile.
It's been a roller coaster, but then you come back home.
So in that sense, we haven't moved that much, but it's been much more volatile than we thought.
Arend, thank you so much for joining us. Arend Kapteyn, they're Global Head of Economics and Strategy Research at UBS Investment Bank. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Alphabet's a global bond spree. Google's parent company raises $20 billion in its biggest ever U.S. dollar bond sale. Issues tech's first 100-year note since the dot-com era. Safe for now, Keir Starmer shores up his position as UK Prime Minister after facing calls to resign over his appointment of Peter Mandelson. Plus, sales at Gucci fall, but by less than expected as the Kering chief executive looks to revive its biggest brand. So Keir Starmer has secured the public support of every member of his cabinet at the end of a dramatic day in Westminster yesterday. The UK Prime Minister had faced calls to resign over his appointment of Peter Mandelson as US ambassador, despite Mandelson links with Jeffrey Epstein. Well, joining us now is Jim O'Neill, member of the House of Lords, former chair of Goldman Sachs Asset Management and former UK government minister. Jim, thank you for joining us. Do you think the Prime Minister should go?
No. You know, I mean, no, I don't. But it is a very febrile moment, this sort of fog of crazy life in the UK that's effectively existed since Brexit just kind of carries on, despite us supposedly having a big refresh. But I think the most thoughtful thing I've heard any major cabinet member say was actually Ed Miliband this morning, I think, that you know, the idea when the public is so sceptical about the whole democratic process in this country and many others, that the sitting government suddenly changes its leader and therefore Prime Minister without going to the public, I think would be strategically a really dumb thing to do. And with it, you know, who would be this great miraculous person to rescue the UK from all the seemingly endless ills that it has? So I think, you know, the Prime Minister's got rid of his Chief of Staff, who clearly was the person behind this very strange Peter Mandelson decision. And, you know, now he's got to get together and get on top of what's needed to improve things. I quickly add, and partly behind my thinking, is if I look at the high-frequency economic data recently, and the fact there's some hints of an improvement in productivity, it's not impossible that in a few weeks' time, if the furore of this dies down a bit, the mood might be a bit different than it seems this morning.
But it does feel, I mean, I don't know whether now we're expecting some kind of reset from the Prime Minister. I mean, it's also likely, you know, never say never, but it's also likely that that Labour don't do so well in the by-election. So does he go after that, or is it a Prime Minister that remains in power as a sort of lame duck?
Well, I mean, who knows? My honest answer is who knows. I mean, as I say, that everything has been so febrile and crazy since Brexit. You know, you've got to have your mind open to anything that would have seemed inconceivable, especially with the rather odd character that's running the free world from Washington. But with that caveat, let's see how he does in coming weeks. I mean, losing Morgan McSweeney is a very big thing, and so there's got to be some kind of reset because the person that drove him has gone. So we will see evidence of whether there's a change for the better or amazingly for the worse pretty soon. But I come back to the question that I have in my head that I touched on, that even if they do really badly in the May elections, what thing would a new leader bring, including this sort of clear disconnect of all major political parties with the public? What thing would it bring? And of course, if the results are really, really bad, then the PM himself might decide out of honour that he wants to step down because he's not the right person. But it's not so obvious to me, despite this crazy 24/7 sort of feeding frenzy about it. It's not so obvious to me why we need to keep changing our Prime Minister every 5 minutes.
Jim, I mean, how do financial markets play into this? Because, you know, they've been brought up in some of this debate that certainly Labour's having, with some of Keir Starmer's allies say, look, you know, markets will be chaos and instability if he goes. How do you think markets would react actually to a replacement?
I mean, I think we saw a pretty interesting mini sign of it Friday and especially yesterday morning briefly, that what lies below it, and partly why this feeding frenzy goes on, is that the lefter wing of the Labour Party, sort of resentful of the way Morgan McSweeney got them into being oven ready for government, at least winning an election. They want the revenge, and so the markets are worrying about if they succeeded and we get a much more traditional, much more eager spending, left of centre new leadership, whether it's Keir Starmer changing to keep them happy or him being replaced. No. That would freak the markets out, and the market showed you that, and they would be right to get freaked out. What is intriguing to me now is whether Keir Starmer and the Chancellor use their fiscal rules a little bit differently in order to have even more confidence that we're entering a period of stronger UK growth.
Jim, I was going to ask you about growth, because I keep on hearing this from a lot of people inside the cabinet, but actually outside, saying we need to rethink growth with something much bolder that Labour for the moment haven't been able to deliver, largely because they're also chasing voters from reform. What would you implement today? And actually, is the Prime Minister strong enough to implement something just much bolder in terms of growth?
Well, again, I emphasise what I touched on briefly earlier. I think, if you look at the highest frequency data and some of the productivity indicators, there are some tentative signs of things actually being a bit better. And whether it's the latest PMI or actually this morning's retail sales numbers for January, so there might be signs of things actually getting a bit better already. And I think, as I've discussed with you before, this whole view that the sort of hike in national insurance last year will be so bad for employment, etc., etc. It might well be that is heralding a beginning of an improvement in productivity. But away from that, and the thing that I'm constantly encouraging our policymakers to do, including this current government, is especially now that they have the second fiscal rule, they should be a lot bolder and more transparent about the big positive multiplier economic projects that would boost trend UK growth. They've flirted with one by announcing finally some details for Northern Powerhouse Rail. That kind of thing, if it's really credible through some very transparent mechanism with the so-called NISTA, which is the new version of the Infrastructure Commission, I think would be an important part of it. And they need to be even bolder and more serious about the reforms to housing planning. And, it's not impossible that these things might start to seem a bit different in coming months. I think many of the areas that need attention, they are focused on. They've just got to be more determined and serious about them.
Jim, as always, thank you so much for joining us. Always a pleasure to speak to you. Jim O'Neill, member of the UK House of Lords, former chairman of Goldman Sachs Asset Management. Now, Bloomberg understands that Alphabet has kicked off its debut sterling bond sale with a rare 100-year note. The deal is expected to be priced later today and comes after it raised $20 billion in its biggest ever U.S. dollar bond sale. With us now is opening trade co-anchor Tom McKenzie. Tom, thank you so much for joining us. I mean, this is huge. It's a big deal, and investors like it.
Yeah, a 100-year note. I mean, what's Alphabet going to look like in 100 years' time? But they're going there, and they think there's going to be demand.
Look like in 100 years?
Yeah, exactly. Valid question. So all of that maybe in the back of mind of investors. But to your point, so far there's a lot of appetite for the debt issuance coming through from Alphabet. The 100-year bond, they think there's going to be appetite from pension funds and insurance industry here in the UK. They had a very successful issuance of $20 billion in the US in a dollar-denominated bond yesterday. There was $100 billion worth of demand, and they raised $20 billion. Yield spreads were pretty tight. They paid just 95 basis points or so above US Treasuries for that. They're issuing in Swiss franc as well. This, of course, is a company that's looking to spend about $185 billion on capex on data centers and chips this year, alongside, of course, the other big tech companies. So yes, so far, and this is just the opening innings. We're going to see a lot more of these big tech companies issuing debt in the public markets and tapping that. And so far, yields have been spread tight. Yields have been tight. Spreads have been tight, and there's been that appetite. And we'll see if that continues. They have the balance sheets to be able to do this, and from the CFO's perspective, it makes sense to get this long-term funding at a relatively low rate.
In terms of what investors do worry about is shortages of memory chips in the shorter term or in the medium term.
Yes. This is becoming pretty acute now for a lot of companies. So you're a winner if you're an SK Hynix or a Samsung, with views from some analysts that this tightness in the memory piece of the chip sector starts and continues into 2027. And you've seen the shares of some of these companies up 160% just in the last few months for companies like SK Hynix and Samsung. There are massive rallies there. The problem is, of course, that leads to tightness in that supply that you're talking about. So if you're an Apple or if you're a Nintendo or even if you're a Chinese car maker that consumes a lot of these memory chips, there's just this massive shortage. You're paying a massive premium. DRAM prices, they've increased just in the last few months about 600%. So you and I could be paying more for our smartphones, for our Nintendo Wii's going forward, Nintendo Switches going forward. That is potentially an impact, an inflationary impact. These chips are being diverted to data centers, and that's a problem. So data center build out, it ties into the spending from Alphabet. Yeah. That's sucking in a lot of these memory chips, which means there's a shortage for the electronics space.
I'm in the market for a console, so higher price. But we haven't chosen which one yet. AI also taking aim at the insurance industry.
Yes, so this was a privately held company in the US, Insurify, coming through with an app yesterday. You saw a big sell-off in US insurance companies. It is the sector that is seeing the biggest losses in the European session today, and it's weighing on the FTSE 100, as you've noticed. Companies like Hiscox under pressure as a result of this. This is a tool that allows you to basically source insurance deals more easily using an AI agentic feasibility and an agentic kind of program. The point is that there's going to be a lot more of these. We had Anthropic last week with its plugins around the legal space and an updated model that arguably challenged asset managers and financial services. We should expect that more AI companies will be coming out with more products that will be challenging different enterprises, different companies, different sectors, and challenging our assumptions about what those business models are, and that is going to create volatility.
Tom, thank you so much. Tom McKenzie, their opening trade co-anchor and our resident tech expert. Now, TSMC, one of the big beneficiaries of continued AI spending, saw revenue jump 37% last month. That's the fastest rate in months. The chip maker counts NVIDIA and Apple as customers and has grown to become Asia's most valuable company. Now, demand for data center chips in particular has spurred TSMC to earmark as much as $56 billion in capital spending this year. And BP is halting its share buyback program to shore up its balance sheet as pressure grows for it to deliver on its turnaround efforts. Now, BP has also withdrawn its standing guidance of returning 30 to 40% of operating cash flow to shareholders. It's been a tumultuous year for the oil major that started with activist investor Elliott pushing for drastic change and ended with the chief executive being ousted. Now, emails released by the U.S. Department of Justice show convicted pedophile Jeffrey Epstein and DP World Chairman Sultan Ahmed bin Sulayem swapped messages for more than a decade after Epstein's jail sentence in 2008. The correspondence shows the men exchanged contacts in business and politics, attempting to broker deals for one another, and made explicit references to sexual encounters. Well, neither bin Sulayem nor DP World have responded to requests for comment. And Kering shares gaining after Gucci sales fell less than expected in the final months of 2025. Well, with us now is Bloomberg opinion columnist Andrea Felstead. Andrea, thank you so much for joining us. Look, Gucci it came from a little bit of a low bar, but actually they're doing good. They're doing much better. What stood out to you?
Well, they're doing a bit better. I mean, sales still declined. It's still very early in the day the tenure of Demna Gvasalia, the new creative director. We're going to have to see how that turns out. But, it wasn't a bit of an improvement. They also spoke positively about Chinese consumers, which is going to be one of the big drivers for this year.
How's Luca De Meo doing? I mean, he took over in September. He was at a big car manufacturer before.
Exactly. He really hit the ground running. He really, he tackled those low-hanging fruit very quickly. Sold the beauty division to L'Oreal. He delayed the deal to buy more of Valentino, shook up the Gucci management. He really moved quickly. Now he's got to go for the next phase of his turnaround, which is going to be much harder. He's talked about, restructuring the group, getting the brands to work more closely together. He talked about the upstream, the industrial side, the manufacturing, cost cutting. He's got to do all that while protecting what is really the key, the creativity, the new, the great products, the excitement around the brand.
Yeah, it's hard because it is a bit of magic, right? It makes you dream, but at the same time, it has to make sense on a business side. What are we expecting from Hermes?
Hermes, I have no doubt will be good. The area that's really stood out is the US. there will be demand for Birkin bags and, things like that. There was a bit of repositioning earlier, sort of last fall, when investors were expecting the luxury space to come back, and Hermes doesn't typically outperform because it can't make as many bags as people want to buy.
What's their secret sauce? I mean, they're outperforming. I mean, like Hermes is just a beat after beat after beat.
It's basically everybody wants these, classic bags, and they'll buy into other parts of the brand to get a feel for it. It also really, caters to that 1%, and that is the bit of luxury that has really held up.
Andrea, thank you so much. Our Bloomberg opinion columnist, Andrea Felstead, with also the outfit of the day. Coming up, I have how a new bridge could be the latest barrier between the U.S. and Canada. We discuss what it means for global trade and alliances with Leslie Vinjamuri, President and Chief Executive of the Chicago Council on Global Affairs. That's coming up next, and this is Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
Where's the emphasis, on headline payrolls or on the unemployment rate?
I'm focused on the unemployment rate, as is the market.
Wednesday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
What we're seeing is certainly a growing labor force.
A labor market that actually could be improving.
The January Jobs Report, Wednesday on Bloomberg.
This year alone, since you asked about FTAs, free trade agreements, we've got a handful that we're moving forward on with India, Philippines, Thailand, UAE, Saudi Arabia, ASEAN, Mercosur. And so you see there's a lot of work ahead of us, but I think the appetite is there from many of our partners around the world to make sure that trade works.
Now, the Canadian International Trade Minister on the free trade deals that the country is negotiating in the face of heightened tensions with Washington. So President Trump says he will start negotiations with Canada over a new bridge that connects Michigan and Ontario, threatening to block its opening until the U.S. is given compensation and ownership of half of the project. Now, the Gordie Howe International Bridge was fully financed by the Canadian government at an estimated cost of $4.7 billion. Meanwhile, China's BYD, the world's biggest manufacturer of electric vehicles, has joined hundreds of companies that are challenging President Trump's tariffs in a U.S. court. The firms, including Costco and Goodyear, are suing for refunds for their shares of the billions of dollars in tariffs that the U.S. has collected so far. So let's discuss how the White House trade policies are impacting alliances and supply chains across the globe. Leslie Vinjamuri is President and Chief Executive of the Chicago Council on Global Affairs. Leslie, so good to have you here in London.
Nice to see you.
I mean, in general, I don't know what we've learned about the Trump administration. I mean, again, it's weaponizing tariffs, it's weaponizing trades. We're kind of used to anything that comes out of the White House. But what's the pattern that you've seen over the last 3 to 4 months?
I mean, I think the pattern is pretty well established now. The president goes all in with a very tough, very coercive deal. Those on the receiving end that don't have the leverage that they need to have to really push back have conceded, tried to strike deals, and then the president has, come down on those tariffs. And the big exception, as we know, that one country that has done fabulously well is China, because it had the ability to really push back. But in most other circumstances, we've really seen, people, state leaders really try to work with the president to make more purchases, to reduce tariffs, to spend more in defense across Europe. It's been a rough ride, but it's been surprising, I think, just over 1 year in, leading up to Munich, to see in the face of a lot of disruption, I think a level of disruption that nobody really fully anticipated or could have imagined. The world is acclimated to this level of disruption, surprisingly so.
Yeah, is that good or bad for trade? So does it mean that actually, at some point there could be trade escalations? I mean, 2025 was, there were tariffs, but actually the rest of the world didn't really retaliate. Could 2026 be different?
Yeah, I mean, look, trade has grown That's certainly the case. There are certain patterns of trade that we know have changed, where it's going. The United States is not taking as many exports from China as it used to. China's still trading. But will there be more backlash, more tariff wars, more acceleration? I don't think so. I think that states, state leaders, people understand and leaders understand that they have a whole lot to gain from trying to manage the disruption and to accommodate the tariffs. And so actually what we're seeing, if you look at the U.S.-India deal, for example, we're seeing some pretty major concessions, some market reforms opening up, liberalization. So I think that actually, this will be continue to be managed. A lot is very hard to predict by definition. We have a president that I think as soon as he sees people sort of acclimate, he's going to do something else that sort of undermines them, comes from left field, because that is the style, that is the tactic. And I think from his perspective, it's been, I think he would say it's been very successful.
I mean, where does Canada go from here? So in Davos, we were both in Davos with that big speech from Mark Carney that was, applauded by most, but he feels it a little bit lonely. That there's not many other middle powers that signed up to his big coalition to kind of be a counterforce to U.S. policy.
Yeah, I think what we're hearing is that that Mark Carney is a little bit frustrated with the Europeans. I mean, but to be fair, he put out a very tall order for middle powers to work together. Sure, I think that's been happening for a very long time. But to what extent can they actually move the needle in meaningful ways without working with the United States or China? That's much tougher, which isn't to, in any way diminish some very significant efforts. And we're seeing, again, trade deals, the EU and India. We're seeing lots of ways of collaborating. But at the end of the day, you need great power, whether it's on the security side or on the economic side. You've got to work with those powers. So, we're in a world which is more multipolar and which there are a whole lot of optionality, but ultimately, working with the United States, working with China is proving to be very significant. So for Mark Carney, he is facing a situation where he's going to have to continue to work with the United States, despite taking, very, very public and strong claims.
If we are in this new world order that everyone keeps on talking about, what does it look like?
This is a good question. And, I think we're all approaching the Munich Security Conference with a huge amount of trepidation to see, for starters, will the transatlantic partnership hang together? I'm on the side of those who think that, it sort of has to. There's no really, but almost more for lack of alternative than because everybody sort of wants to be in it together. But a future world order, I think one that, where there's a lot of unpredictability. I think we have years of disruption ahead of us, but where states learn to diversify their partnerships, to build internal resilience, hopefully, that's leading to a whole lot of very good things in the case of Europe, in the case of India, and in the case of Southeast Asia in particular. But these are very long-term plays.
I mean, we talked a little bit about India. Where does China fit into all of this?
China seems to be benefiting hugely. I'm certainly on the side of those that think, China's got a very clear strategic focus on what it's aiming to do, that it's benefiting from the U.S. and the West, those alliances being disrupted and unsettled and distracted almost continually. And being able to singularly focus on its economic change, focusing on high technology. Clearly, it's going to have to deal with all sorts of internal domestic problems. But still, in the scheme of things, if you compare it to the position that the United States is in domestically, it seems to be, again, much more singularly focused and benefiting from a West that is sort of at war with itself.
I mean, is the EU just slowly disappearing, or I'd say Europe?
Look, we're here in the UK, which is part of the greater Europe, maybe not the European Union. I don't think it's disappearing. The challenges are very real. I think there's a huge amount to play for. I mean, Europe has to do well because, Europe sits in a very strategic place. It has has all sorts of internal barriers to being more dynamic, more innovative, more creative than it deserves to be. But I think that there's an intentionality now. The problem is it's a bunch of different states. It's not one place. Lots of different interests in that Europe.
Yeah, and Europe usually is good in a crisis. So let's see over the next couple
pretty good in a crisis.
Of days and weeks. Leslie, as always, thank you so much for joining us. Leslie Vinjamuri, President and Chief Executive of the Chicago Council on Global Affairs. Up next, it's Bloomberg Brief, and this is Bloomberg.